we have to take into account that cutting gas from Russia is one of the key options.
It's great to see so many jobs created. It's great to see wage growth at 5%. It's great to see an unemployment rate at 3.6%. But we need labor force participation to go up.
The country is, with President Biden laying out the plans when he took office, is still moving forward on the job side, but there's still a lot of unanswered questions about the economy. It's still kind of in a very, interesting place.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, happy Monday, and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, and all week for Francine Lacqua. Here's what's coming up on today's program. Prepare for cutoff. French Finance Minister Bruno Le Maire says Europe must be ready for a complete halt in Russian gas supplies. Nord Stream shuts for maintenance today. 11 chase number 10. The race to become the UK's next prime minister heats up as Liz Truss is the latest to join the contest. Plus, Elon Musk's decision to scrap his bid for Twitter could be decided in court, the social media giant lining up heavyweight law firm to force the deal through. It certainly is risk aversion throughout the market. Probably will be for Twitter today when we get the pre-market action shortly. But elsewhere, we are looking at European equities that are falling following the Asia session lower. Asia, there's concerns there about the reemergence of Covet. A detection of the new highly contagious variant means that growth concerns are abound. So we're looking at European stocks down 1%. Every sector in the red being led lower, mostly by basic resources. Tech, that's down more than 1%. Nothing is safe in this market as we also concern ourselves about the energy crisis in Europe. A little bit weaker in terms of energy pricing today, thanks to Canada providing a stranded asset for Nord Stream. Perhaps that will help. But meanwhile, it is all about dollar strength. Your Bloomberg dollar spot, that's up 0.5%. The euro at a 101 handle, continuing to slide towards parity. It's that U.S. jobs number on Friday, very, very strong. 75 basis points. Is that a certainty at this point? We're also going to get U.S. CPI later this week, so that inflation number might tilt its hat more towards the fight the Fed has on its hand. Bitcoin, that's also down more than 2.5%. The latest MLive survey says that Bitcoin could have from its current levels, the target there, $10,000. Let me show you what the entirety of Europe looks like this morning. Again, it is a very red morning. It's a lot of negativity out there following a U.S. session on Friday that just barely was flat. Europe was pretty strong on Friday, so it's a little bit of catch-up. But again, it's also that growth story as well, the concern when it comes to China and energy. Are we going to see a stop of Russia flow of gas through to Germany? Now, I mentioned Twitter. I want to show you what the pre-market session looks like. This, of course, comes after Elon Musk said that he was dropping the $44 billion deal on Friday. Twitter says that they will pursue legal action in order to make sure he follows through on that deal that is signed. 8% decline, more than 8% decline is what we're seeing pre-market. $33.65 is where we stand on Twitter in the pre-market session. Well, with that in mind, we'll put a hold on that, revisit Twitter later in the show. But let's get to the UK story. Britain's Foreign Secretary Liz Truss, she's launched her bid to replace Boris Johnson as party leader and prime minister. At the heart of her campaign are tax cuts, including a pledge to make corporation tax more competitive, if I can find my words. Let's bring someone in who always has her words ready to go. It's Bloomberg's UK reporter, Lizzie Burden. So, Lizzie, Liz Truss now in the race as well. We know 11 people are in it so far. What does sort of the leading candidate, the top of this race, look like?
Well, Danny, you've got lots of high-ranking candidates. The former Chancellor Rishi Sunak, the current Chancellor Nadhim Zahawi, the Foreign Secretary Liz Truss, and they're dividing on tax as the major fault line to start off with. On the one hand, you've got candidates in an arms race trying to offer the biggest tax cuts, and on the other hand, you've got Rishi Sunak saying that the fairy tales need to end. It's time for fiscal discipline to deal with the cost of living crisis, because, of course, those tax cuts bring concerns about inflationary pressures. But the tax debate aside, the mudslinging has already begun. A video resurfaced over the weekend of Rishi Sunak being dismissive to the working class. Some are saying that that could have come from Boris Johnson, his former boss, trying to sabotage his campaign as revenge for bringing down Johnson himself. But the Conservative Party wants to bring it down to 2 candidates by July the 21st and then allow the membership to vote for just one candidate by by September, though we could have a prime minister much faster than that if there's a big gap between the two candidates and one of them drops out.
Lizzie, you mentioned the inflation picture. You mentioned what tax cuts could mean for that. I'm looking cable right now, trading below 120. What would all of this mean for markets depending on who is at the helm of the Tory party?
Well, of course, Johnson's resignation raises the chance that we get a general election earlier than we had expected. We thought that one was going to come by January 2025 at the latest. But whichever candidate wins might want to capitalise on their political honeymoon. That means that we might get a run of pre-election spending. And if Labour happen to win the election, we could get some post-election spending. So all of that has consequences for the Bank of England, for the pound, bonds, stocks. NatWest strategists are already seeing faster rate rises from the Bank of England. But if the new leader can't get a mandate like Boris Johnson won in 2019, which is seemingly unlikely at this point, it could spell months more political instability, which of course the markets wouldn't be helped by.
Lizzie, thank you very much. Bloomberg's Lizzie Burden outside of Westminster. We're now joined by Agnes Belaisch, Chief European Strategist at Barings. Agnes, thanks so much for joining. I want to talk about the wider Europe story, but first starting local here in the UK. When you look at the strategy of the UK, when you look at the Bank of England and their projection of rate hikes, does the Tory government, does who becomes the next prime minister make a big difference in your strategy going forward in the region?
Good morning, Dennis. So the UK is probably the only country in Europe that hasn't done much of an active energy policy in terms of supporting demand by reducing prices or putting a cap or giving subsidies. So actually electricity prices in the UK are the highest that they are in Europe. So I suppose the new government can have a role less on or indirectly on central bank policy, but mostly on fiscal policy, and deciding what it does there for energy prices will have, of course, an impact on how much hawkish or more hawkish the Bank of England needs to be.
Well, certainly this market is pricing on when it comes to the whole of Europe as energy being the chief concern. Agnes, I love what you write. The irony of it all is that euro area fundamentals are strong, but still, I'm looking at a euro which is quickly on its way to parity. Does the market have something wrong?
Okay, so this is the big dilemma of the moment, which is the fact that governments have not looked straight in the eyes at this energy rationing. That's probably going to come in the fall, if not earlier, in July, with this Nord Stream 1 being under maintenance period, and we don't know whether it's going to come back fully. This is massive shock ahead of us. This is completely binary. Either Putin does it or he doesn't do it. There's no scenario exactly that can design how it's going to go, and governments have not really talked about it. And you have this underlying growth, not only from the recovery of tourism and services in general, but also from the manufacturing sector with the easing of supply disruptions or bottlenecks in Asia to some extent, unless of course they come back. But the order book in Germany is 5 months of work without anything happening. So the momentum is quite strong, but of course, if you have the mother of all commodity shocks in front of you, this is not going to sustain really long.
Walk me through that scenario. What would it look like if we do see Russian gas flows to Europe completely cut off?
So the first one is the first risk in the near term, since Nord Stream 1 is under maintenance period today for about 10 days, is if that pipeline doesn't come back, and there is about a quarter of all energy exports from Russia that come through this pipeline, in particular to Germany and Italy, but mostly to Germany. The pipeline arrives in Germany. And there would be two solutions there if it doesn't come back. Consumption would have to fall. That's about a 15% fall in consumption. 50% of German exports of gas come from Russia, and a quarter of that from that pipeline. So that's a 15% fall in consumption that needs to happen. And we know from what the government has said, and that can happen later down the road in the fall, of course, when Putin will have a stronger hand, because it's the start of the heating period. So we don't really know when that starts. But whenever it starts, consumption will have to fall. There's some margin of substitution in energies, but most of it will have to come from lower consumption. And the problem is that energy is an essential good, and it's not something that can be really radically fast compressed. It's something that happens over time. And governments have not really prepared their population for that. So I expect kind of a hard shock on the economy, unfortunately.
But is it binary in terms of whether we get a recession or not? For example, if we don't have Russia completely cutting off gas flows, will Europe still enter recession, but it's just a matter of how deep it is?
Yeah, that's the thing. So for me, I call that binary. If it doesn't cut, if Russia doesn't cut gas exports to Europe, then there's not necessarily a recession at all, and we don't have that in our baseline scenario at the Barings Institute. However, if there is a cut in gas, there's just no avoiding a recession, simply because manufacturing, industry, services cannot work without energy, and energy would be missing. And I would like it, I think I would like it that governments actually try to warn their population about what's ahead.
Agnes, much more to discuss. Stick around with us. Agnes Belaisch, Chief European Strategist at Barings. Let me give you another check on Twitter at the moment. Of course, this after Elon Musk said he is dropping his bid. Twitter hiring some top legal force to pursue Elon Musk in the legal system for him to complete this deal, which of course he signed. $44 billion on the line here. Twitter down 6.8% with 10 minutes underway in pre-market trading in the U.S. Coming up, could the Fed be heading towards another jumbo rate hike this month? At least the latest U.S. jobs data suggests it could be so. We're going to have more analysis of that next. This is Bloomberg.
This was a strong employment report.
It is a strong report.
This is a solid report.
But it has one disappointment.
The lack of an increase in participation.
We need labor force participation to go up.
The Fed is going to have to do more.
This Fed isn't stopping.
Interest rates are still considerably below where they're going to need to be.
Today's number just gives them the green light to do that 75 basis point rate hike in July.
This Fed is going to do 75.
Definitely 75, I think, is in the cards.
Very likely to go 75 basis points at the next meeting.
They're going to go to 75. I think they'll get a 50 done in September.
Probably another 50 in September.
Deliver as many hikes as they can between now and September.
But then I think this thing is good. They're going to have to slow down.
And then perhaps think about slowing down the pace of hikes after that.
Some Bloomberg guests there reacting to the strong U.S. June jobs number that had unemployment near a 50-year low. Yields surged after the report. Agnes Belaisch, Chief European Strategist at Barings, is still with us. Agnes, we were just talking a moment ago about the binary nature of the energy market in Europe. Talk to me about the binary action in stocks and bonds dependent on whether or not it's hikes on or hikes off.
Exactly. Ho-ho, it's hike on or hike off. And the irony of it all is that any good data is interpreted as more hikes, and therefore there is a sell-off in asset prices, be it stocks or bonds. And any bad data is actually a good news for the market, because that means less hikes. And it's interesting that the market is so worried about rate hikes when interest rates are so low for now and inflation is so high. And you got to wonder, the situation is completely different in the US and the euro area. But you got to wonder why so much focus on monetary policy when there's very little that it can do about the sources of these higher prices.
It's true, right? It's all about the supply side at this moment. Yes, you can bring demand down, but can you really bring it down low enough to get into line of where supply is? Agnes, what does that mean around how you trade this? Should we be looking past the rate hikes and be looking towards something else?
Right. So it's no time for a heroic move, but there is one move on the market that seems to make the most sense to me, which is the role of energy in our future. And I think maybe this crisis, this war, has made us realize how important it was to substitute maybe faster than needed from fossil fuel to renewable energy, but also try to find some security in the supply. And the problem there is that switching to renewable is not necessarily going to reduce or improve our energy security or reduce our energy independence, given that the metals and minerals needed to build all these renewable energy actually come from type of emerging markets with whom we don't really have a close, knit relationship. So energy stocks would seem to be diversified over fossil fuel to power the energy transition, as well as those companies that actually produce these renewable sources of energies seem to be a no-brainer. And then you have all these tech companies that actually facilitate those investments in renewable energies, but also we might come back and support working from home in case there is actual energy rationing in Europe at least. And then there is, of course, all the strong balance sheet companies, which would seem to make sense right now as asset managers want to reduce risks. And strong balance sheets are really the name of the game.
But if we do enter a recession this time, Agnes, how different will it be from prior recessions? Because usually energy, you don't want to be there. It's very cyclically exposed. Is it a different playbook this time around than recessions past?
That's the thing, is that if we think about why there is a recession right now, as we just discussed, it's not because the fundamentals of the economy are weak. It's because we're facing this mother of all commodity shocks. This is textbook 101 when you learn economics. And in those economic books, it is caused by a war. And this is exactly what's happening. And in such case, what has value is what is the short side of the market. And the short side of the market is the supply of energy. So you can have traders trying to price in a little bit of demand compression. This is the recession that we talked about that has been weighing on prices right now. But this is not anything that's going to disappear in the next 3 to 6 months. It's going to take a long time to recover the supply of energy we are used to, and or for demand to actually compress. So energy stocks are the guardian of the temple in a way.
Agnes, thanks so much for joining us this morning. Agnes Belaisch there, Chief European Strategist at Barings. Now let's get to the Bloomberg First Word News. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. The main pipeline bringing Russian gas to Europe goes down for 10 days of maintenance from today. French Finance Minister Bruno Le Maire says the continent must prepare for Moscow to shut off supplies for good. Le Maire says France is doing everything it can to avoid power shortages and needs to be careful with energy consumption while building up gas stockpiles. Now, the Speaker of Sri Lanka's parliament says President Gotabaya Rajapaksa will step down this week after months of protests over fuel shortages, surging prices and financial mismanagement. The president fled on Saturday to an undisclosed location shortly before demonstrators stormed his official seaside residence. Inflation is set to hit 70%, with the IMF saying it will continue discussions on a loan program. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you very much. Coming up on the program, Twitter is said to be forming a legal powerhouse team as it prepares to take Elon Musk to court. We'll have the latest on the $44 billion deal gone wrong. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Get set for a titanic legal battle between Twitter and Elon Musk. Twitter has hired a merger law heavyweight as it races to sue Musk for dropping his $44 billion takeover of the company. Let's bring in Bloomberg's Laura Wright, who over the past few months has unfortunately done a lot of Twitter and Elon Musk coverage. Laura, I mean, to some degree, this can't be too surprising that Musk has dropped the deal.
Not too surprising. Evidently, Elon Musk's enthusiasm has decreased while his criticism of the social media platform has increased since his offer was first accepted at the end of April. You can see ahead of the US bell, Twitter down almost 7%. We are seeing somewhat of an inverse correlation, with Tesla reacting positively, up around 1%. So Elon Musk's team filed that termination on Friday, and really it came down to a trio of factors. Elon Musk feels that Twitter's management have not been forthcoming with information surrounding the number of fake accounts on the platform. They also think that Twitter has been disingenuous to the US financial watchdog. And interestingly, Elon Musk was unhappy with a number of recent dismissals over at Twitter. Meanwhile, Twitter's chair, Brett Taylor, tweeted over the weekend that Twitter continues to work on the assumption that the deal will go ahead at that agreed $54.20 share price.
Twitter, in fact, expected to file in a Delaware court today, kicking off those legal proceedings. So in terms of where we stand now, what are the potential scenarios that could take place? Either Elon Musk is forced to go ahead with the deal, or one of the parties has to pay that $1 billion exit fee. Legal consensus is that it will be Elon Musk. Perhaps the two parties renegotiate a lower price, or they settle out of court, but the latter appears to be the most unlikely at this stage. Laura, thank you very much. Bloomberg's Laura right there with all the latest on Twitter and the battle with Elon Musk. And as Laura pointed out, looking at Twitter falling about 7% pre-market, there's already skepticism about the deal, but that just fueling this. Will be interesting to see how that shakes out, whether that goes to Delaware and what the court decision looks like there. Now, coming up just 2 days after the assassination of the former Prime Minister Shinzo Abe, Japanese voters hand his party a big victory in elections to the upper house. We're going to take a look at what that means for the country and its economy as the yen continues to drop, trading at a 24-year low. All of that next. This is Bloomberg. Prepare for cutoff. French Finance Minister Bruno Le Maire says Europe must be ready for a complete halt in Russian gas supplies. Nord Stream shuts for maintenance today. 11 chase number 10. The race to become the UK's next prime minister heats up as Liz Truss is the latest cabinet minister to join the contest. Plus, Elon Musk's decision to scrap his bid for Twitter could be decided in court as the social media giant lines up heavyweight law firm to force the deal through. The social media giant drops in the U.S. pre-market session. Good morning. Happy start to your week. Happy Monday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. A negative session so far this morning. European stocks trading down in the red as the dress that I'm wearing today. Is what these markets look like. European stocks down 0.8%. We are not just contending with really strong job numbers in the U.S. that more or less solidify that 75 basis point hike, but we still have those growth concerns for China. New cases in Shanghai of Covet, the concern of the Omicron variant, the highly contagious one, starting to spread as China commits to their zero COVID policy. What does that mean for growth? You can see some of the concern manifesting itself in the price of NYMEX crude this morning, dropping back towards $100 a barrel, down 2.5%. Euro parity still on euro dollar parity watch with a 101 handle this morning, down 0.6%. Again, it's U.S. jobs feeding into that. It's the energy crisis in Europe with Nord Stream 2 undergoing maintenance today. Will Russia use that as an excuse to stop the flow of gas through to Europe? Also feeding into the negative sentiment this morning, Bitcoin below $21,000, down 2.3%. The latest MLive survey says we could see $10,000 on Bitcoin. Of course, that's a drop of more than 50%. We're also watching the yen this morning dropping to a 24-year low. All of that off the back of, in Japan, the ruling coalition expanding its majority in the upper house of parliament. Sunday's election are a boost to the current Prime Minister Fumio Kishida, who won't need to face another election in the national sense for 3 years. Voting was held just 2 days, of course, after the assassination of former Prime Minister Shinzo Abe. For more, we're joined by Gearoid Reedy, Bloomberg News senior editor in Tokyo. Gearoid, so is this a big mandate, or at least a bigger mandate now that Kishida has been handed?
Certainly it is a mandate. There's always the problem with upper house elections and with elections in general in Japan of low turnout. But it certainly does give Kishida a platform now on which to build. Since he became prime minister late last year, he's had to face several elections. First, he had to get the election to become party leader to replace Yoshihide Suga. Then he had to, very quickly after that, about a month after that, he had to do a lower house election. And now this is the final test that he has had to pass in order to get a stretch at putting together his policy proposals. And so now he doesn't have to face the polls again for about another 3 years. That gives him a little bit of breathing room, a little bit of chance to see what he can actually do on the policy front.
To what degree did the shock and the sadness of Abe's assassination just a few days before color the result of this election?
I think it's difficult to tell. We saw a slightly higher turnout than was expected. Upper house elections do not tend to attract a very high turnout in general, and indeed that was the case this time as well. It was not the lowest in history, which many recent upper house elections have been, and the turnout was up a little bit on the last election in 2019, possibly or likely as a result of support in the wake of Abe's assassination. It was a strange couple of days. I think here there was also a little reluctance maybe to go all out on mourning for Abe as a result of the election also being just around the corner.
All right, Gerold, thanks so much for joining us. That was Gerold Reedy, Bloomberg News Senior Editor in Tokyo. We're now joined by Kristen Surik, Assistant Professor at the London School of Economics. Kristen, thanks so much for joining us. So we have this victory coming from the LDP on Sunday, again, just a few days after the shock assassination of Abe. How would you characterize the results of the Sunday upper house election?
Given that turnout was higher than expected, I think it suggests that there is wide support for the policy platforms that Prime Minister Kishida is putting forward. Those are mainly an extension of Abenomics, although not necessarily a name, as well as a push to revise the constitution so that Japan can develop a full-on military.
Yeah, so Abenomics perhaps not in name, but there was an element, it feels, when Kishida first came in, this idea that he wanted to distance himself for it. What does that mean for the legacy of Abenomics and that desire, perhaps, to get away and for Kishida to foment his own path forward?
That is indeed the case. He has come in with a need to distance himself from the previous prime minister. But in terms of the actual content of the policies, it's not too terribly different. So in a way, he's trying to define himself. He's walking a very close, very fine line between taking on the legacy of Abe, which was in many ways very successful for the LDP, the Liberal Democratic Party, while carving out his own space, saying this is not just a continuation of what was going before. But if you look at what's actually going on in terms of increased fiscal loosening and now actually inflation is slightly over 2%, it is very close to the main content of Abenomics.
It is interesting when you bring up this inflationary environment, Japan finally seeing a bit more of it, perhaps not as much as perhaps here in Europe, but we have seen a lot of government turmoil off the back of really high inflation, be it in the U.S., poor approval numbers for Biden, or in the more extreme cases, you look at Sri Lanka and the protesters there. Why is it in Japan there's a difference there in terms of the general public perhaps not voting in the election based on discontent over rising prices?
Well, first of all, prices aren't rising very much. So inflation in Japan at the moment is about 2.8%, which is considerably less than what we see in the UK at around 11% or in other countries as well. So prices are indeed slowly rising. But not as much as in other places. But it's notable that they are rising in the first place because prices pretty much have been stagnant since almost 1990, which is quite astounding. And where it will hit people in households particularly is that wages are not increasing. So this squeeze going into families has been going on since, for about 5 years now. But there's a sense of general contentment that people get by with enough, that there's enough that education is taken care of, that health is taken care of, that things are just about okay, that people haven't really turned out in masses on the streets or thrown out governments, for example.
So, Kristen, that's the domestic. When it comes to the international, Abe often spoke of a free and open Indo-Pacific. Even sort of the term Indo-Pacific really came into the fore because of Abe. What sort of legacy does he leave behind in terms of a more open, a more global Japan?
There, his legacy is very crucial. It's been very fundamental. He was the prime minister who traveled to more countries than any other prime minister had in the past, signed more trade agreements than any other prime minister, and did quite a lot to move Japan into the global sphere in a new proactive way. If not always in the same sort of limelight as countries with big overseas military forces. However, he was very crucial behind the Trans-Pacific Partnership and has done a lot of sort of back channel work as well, signing agreements. And so in that sense, it's been very important for Japan. The other side of it, though, is Japan's relationship with North Korea and China, as well as now Russia. It's in a neighborhood where tensions can increase quite significantly at the drop of a hat. And so what this will mean going forward, Abe was although he was a very conservative nationalist, he was very good at sort of walking the fine line between claims about Japan's glorious imperial past and being pragmatic when it came to economic issues with its neighbors. Right. And so what goes on going forward, especially with China and Russia, remains to be seen.
Kristen, I'm afraid we're going to have to leave it there. Thanks so much for joining us today. That's Kristen Serac, assistant professor at the London School of Economics. Coming up, France warns that Russia is likely to cut off its gas supply to Europe in retaliation for the EU support for Ukraine. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Dufry, the world's biggest duty-free company, has agreed to buy Autogrill from Italy's Benetton family, creating a new $6 billion player in the travel retail market. The combined group will have 5,500 outlets at some 1,200 airports and other locations. Now, leaked documents reportedly show that Uber lobbied politicians, including the French President Emmanuel Macron, and broke laws as part of its global push between 2013 and 2017. The so-called Uber files of more than 124,000 documents cover when co-founder Travis Kalanick was CEO. In a statement, Uber didn't deny the allegations, but focused on how much it had changed since then. And Macau is shutting down its casinos and most other businesses for a week as the COVID outbreak worsens. The measures return the gambling hub to the toughest pandemic restrictions. These include limits on people entering public markets and daily PCR tests for service workers. Macau last shut its casinos due to COVID back in February 2020. And that's your Bloomberg Business Flash. Danny.
Leanne Gerrans there. Thank you so much. France says Europe must prepare for Russian gas deliveries to be shut off entirely. That's in retaliation for the region's sanctions on the Kremlin and support for Ukraine. This all comes as the Nord Stream pipeline, which of course runs from Russia to Germany, will go into annual maintenance for 10 days.
We have to be prepared to all options. You know, that's the responsibility of all politicians to take into account the geopolitical situation. We have to take into account that cutting gas from Russia is one of the key options.
Let's go to Berlin, where Bloomberg's bureau chief Birgit Jennen is standing by. Birgit, how concerned is Germany over the shutting down of Nord Stream 1 and the possibility that this is the turning point for halting the flow of gas?
Well, the government is clearly concerned. The economy minister, Habeck, has said that really it's totally unclear what is going to happen after the maintenance work. So they are preparing currently for the worst case scenario, which would be that Russia is cutting off gas altogether. But they're getting mixed signals. Some hear that maybe the gas is cut off by 50%, 20%. Maybe it's coming back altogether. So the government is actually currently sort of in a limbo, looking at different scenarios, but planning for the worst.
So walk me through the scenario, Birgit, then, if gas was suddenly cut off.
The government has already set in place an emergency energy plan. So that is looking at companies which are systemically relevant, and these companies need to continue to get supply of energy. But at the same time, they're also looking at companies which can do with cutting back gas. So they will ask these companies to basically reduce their consumption. That is one way of dealing with a shortage. The other is basically asking the consumers and also putting some more constraints on the consumer in the energy consumption. And they are also looking at means to pass on the rising energy prices to the consumer. This is obviously for the government the last option, because it would be at risk of turning the tides, turning the public opinion against Russian sanctions, which the government wants to prevent.
Yeah, we were just talking with our last guest, Agnes, who basically said, look, the government hasn't done a good enough job in preparing the general population for that possibility. Birgit, thanks so much. Birgit Yenin there, our Berlin bureau chief, on the latest when it comes to Nord Stream. Now to the ECB, and Governing Council member Yannis Stanaris says a new policy tool may not be needed to be used. That's if it's powerful enough. He spoke exclusively with Bloomberg's Caroline Conan on the sidelines of Aix-en-Provence Economic Conference.
As you know, our policy is characterized by a trio: gradualism, flexibility, and optionality. My view is that we'll start with 25 basis points, and then we'll see. As you know, Europe is in the midst of a storm after the war, after the invasion of Russia into Ukraine. Europe is a very large net energy importer, so it suffers from a large negative terms of trade effect. That makes it different from the United States.
But in your opinion, when approximately do you see inflation in the Eurozone peaking?
If the situation is without any negative surprises on the energy front, then inflation definitely will start falling towards the end of this year. And will approach our target in 2024.
Do you think that stagflation is the likely scenario then?
There are stagflationary winds there is blowing. There is no question about that. And this is a very nasty supply side shock. But for the moment, we don't expect negative growth this year or next year on the baseline scenario. I repeat that, but we cannot exclude an adverse scenario which has to do with negative surprises on the energy front. We might have recession next year. Then we'll consider our position again.
Of course, one of the concerns is, of course, fragmentation. The ECB is supposed to unveil a new tool in order to fight this fragmentation. Do you think there is a danger that perhaps if conditions are too strict, this will make this tool unusable?
I'm sorry, I cannot go into the details of the discussion because the discussion goes on now. It's a very good debate in a very good spirit and good cooperation. I'm sure that at the end of the day, we will have a consensual, efficient solution. Yes, I believe that there is a lot of truth in the idea that if we convince markets that this is going to be a strong tool, we might not need it at the end of the day. We'll have it on the shelf. It is a possibility that if we convince markets that it is like a whatever it takes tool, I think there's a very high probability that it will not be needed. I hope that will surprise markets on the positive side.
ECB Governing Council member Yannis Stanaris there. The ECB having an extremely difficult task on its hand. We were just talking to Birgit Yenin, our Berlin bureau chief, about the possibility that gas flows from Russia to the rest of Europe might be cut off. That coupled with, on the other side of the Atlantic, a Fed which is going at it, really strong unemployment data coming out on Friday. That differential in yields continues to punish the euro. The euro right now trading at a 101 handle. It got very close to parity on Friday, at one point falling to 1.0072. So it narrowly avoided parity off the back of those jobs numbers. But we are quickly headed that direction, consensus building around parity. But all of that also has to do with the strong dollar. The strong dollar has been punishing stocks. You're looking at European stocks right now falling this morning, a lot of risk off. But Mike Wilson over at Morgan Stanley says that the stronger dollar will be one of the massive headwinds for equity markets, especially U.S. mega cap stocks. And look, we've already heard some of the warnings of this. Microsoft last week essentially saying that the strong dollar will hurt their profitability in the second quarter. Already there are concerns for what earnings will look like this season, whether strategists and analysts are too optimistic about earnings, not just the margin squeeze, not just higher inflation, not just consumers less willing to shop around, less willing to make those big purchases. But again, now it's the currency effect as well. So the risk off in today's session, European stocks down 0.7%. France underperforming, all sectors in the red today. Again, it's not just the story of gas, but it's also some of the weakness coming out of China. There's new variants in China when it comes to the Omicron, the very contagious one. Shanghai, China, they remain committed to zero COVID. Again, the concern there, that will slow growth. We're also looking at oil, WTI now down 2%. Well, coming up, the blues might also deepen for Bitcoin. The leading cryptocurrency looks to be headed for another steep dive. That's the conclusion of our latest MLive survey. We're going to have more on that next. This is Bloomberg.
We are in a crypto winter, so again, that could be an area where you dabble. You know, I wouldn't necessarily allocate large chunks of my portfolio to it, but I am comfortable taking, you know, smaller positions.
The volatility is excessive. It's volatility like currencies, but nevertheless, it can find a place in that portfolio. Notwithstanding, you know, what I've said, it's very difficult to predict.
We struggle to find a valuation model. How do you value Bitcoin or the other cryptocurrency? So we have always advised our clients or investors to tread carefully.
It is very much a risk asset rather than a store of value. And it is, in some sense, a bet on a business model that is very much yet to be proven.
My suspicion is that this is here to stay. And I think that, as I said, you know, you write off the mass movement of these, you know, super talented, super ambitious people at our peril.
Bloomberg TV guest there on what's next for Bitcoin. For what it's worth, we just had an MLive survey, and the majority of the results said that Bitcoin could fall to $10,000. That's more than a 50% decline from current levels. Speaking of big declines, let me get your check on Twitter. It's been trading in the pre-market session for nearly 1 hour, dropping more than 6%. This follows Elon Musk attempting to end his agreement to buy the company for $44 billion. It's alleged that Twitter has misrepresented user data, that it's not giving Musk and his team enough data when it comes to the problem about bots. Jefferies currently, they say they wouldn't be surprised if they see the stock find a floor at $23.50. To give you an idea of what that would mean, Musk, of course, bid for it at $54.20. It's currently about 36% below that, considering this morning's drop. If it goes to where Jefferies says it was, that's another 30% decline. That's around where it was trading near the pandemic levels. They basically said it's Brent Thill that leads the team over there, saying that attention will return to core fundamentals, which they believe have been rattled by this process and headwinds facing the online ad industry. So with Musk gone, it could be a steep decline to come for Twitter. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Milley and Kailey Leinz will be in New York, Anna Edwards in London. More Twitter conversations to come, I am sure. This is Bloomberg.
Fed needs to catch up. They're not just reacting, they are catching up. And that's why they simply cannot wait.
They need to move now. Those consequences will come later, and hopefully they won't have to go too much higher too much later.
Growth is going to slow down. We're all going to be watching the Fed, whether they blink.
What you have is a market that is very laser focused on getting recessionary signals.
What you're going to see is the pause in this rally. You know, we don't think that this rally has much strong legs to stand on, and it isn't sustainable.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Our top stories today: Elon Musk makes a U-turn on Twitter. We have the latest on the likely Delaware court battle as the social media platform hires an M&A heavyweight to file suit. And another challenge to China's COVID-0 policy, a growing outbreak in Shanghai. Meanwhile, Presidents Biden and Xi are set to meet in coming weeks to discuss the easing of tariffs between the two largest economies in the world. Plus, a warning for Europe. French Finance Minister Bruno Le Maire says the continent must be ready for Russia to cut off gas deliveries completely in retaliation for sanctions. Good morning and welcome to Bloomberg Surveillance. Kailey, let's check out what's going on in Asian markets first, because we had an interesting week and we're down on U.S. futures.
Yeah, well, it's mixed in Asia. At least that was the case overnight, Matt. On the one hand, you had Japan actually outperforming. Of course, 2 days after the assassination of former Prime Minister Shinzo Abe, those upper house elections were held and saw that ruling Liberal Democratic Party expanding its majority. Perhaps a sympathy vote somewhat at play there, but nonetheless, that is a sign of stabilization in Japan, so that actually lifted equities higher by about 1.4%. However, it also is seen as an endorsement of Japan's easy monetary policy, so that weighing heavily on the Japanese yen, the big underperformer in Asian FX, trading against the dollar right now at 136.97, which is the weakest level going all the way back to 1998. Now, elsewhere in China and Hong Kong, you saw stocks dragged lower. Part of that drag was in technology. The Hang Seng Tech Index down about 3.9% overnight after Alibaba and Tencent were fined for past deals. But the broader overhang on those markets also is COVID-0, the cases in Shanghai that Matt mentioned. Also, Macau shutting down almost all businesses for a week, including casinos, and that weighing heavily on casino stocks. Bloomberg Intelligence's gauge of Macau casino stocks down about 5.6% overnight, Anna.
Kailey, European equity markets then suffering from a bit of a lack of confidence, it seems, this morning. This Monday morning, we see European stocks heading lower. The Stoxx 600 down by 0.6% or so. And it's really the hangover still from that data we got out of the US on Friday that's still having an impact here. We closed on European markets fairly positively compared to the US close on Wall Street. So we're playing a little bit of catch up. And also when it comes to that US data, the tightness in the labor market, reminding investors globally about the interest rate hikes that still could be brought forward and introduced by central banks globally, notably by the Fed, of course, and all of that taking the wind out of the sails of risk assets, it seems, and that continues to be the story this morning here on European stocks. The euro is responding to a lot of dollar strength, and Kailey just went through what we're seeing there with regards to the yen. Well, the euro is on the move this morning as well, but it is really a dollar strength story. We've got the euro weaker, we had the pound down by 0.5% as well, and it's interest rate differentials that once again are to the fore here, as that jobs report reminded everybody of just how aggressive the Fed might be when it comes to interest rate hikes. We saw a big surge in yields on the back of that data on Friday. Well, some of that being unwound today, some of those yields coming down. I've got here 2-year French yields, but really the trend is across many different tenors, many different geographies, but yields moving a little lower as we see some buying of those havens. And natural gas prices down by 1.6%. They were down by much more than this, Matt. And this is an interesting nuance to the story. Of course, we all know about the geopolitics and what's going on here between Russia and its supply of gas to Europe. They're shutting down that pipeline for maintenance for 10 days or so. The big question is whether that gets turned on again. But in the meantime, a part that had been missing and was blamed by the Russians for part of the reason they'd reduced the flow in the first place, that part is being returned from its maintenance trip to Canada. And so we'll see whether that changes the dynamics at all when that pipeline is set to reopen.
Watching that closely, of course, the strong dollar is weighing on a lot of commodity contracts today. We have S&P futures down about 0.5%. This after a positive week last week. It was the 9th positive week so far this year. They've been seemingly few and far between, but actually 9, it doesn't feel so bad. 10-year yield coming down just a couple basis points to 3.0616 right now as investors buy that debt. And NYMEX crude, as I said, one of the commodities being weighed on by the strong dollar. Right now off 1.33%, or $1.42 to 103.37. So still holding above that $100 level. And Bitcoin falling about 2% from midnight to 20,546. Remember, it ended the week last week at over $21,000. But there's an MLive survey today where I think about 60% of respondents think it's headed to 10 before it goes to 30. Kailey, did you see that MLive? Are we going to talk about that MLive survey today?
I did, and yeah, we're going to have more on that later on this program. As for what is ahead later on this week, starting today, Nord Stream 1 shuts down for 10 days for annual maintenance, which Anna mentioned. Western allies fearing that President Putin will use the opportunity to cut off gas flows to Europe for good. Then President Joe Biden will take a trip to the Middle East. That's kicking off on Wednesday. Also on Wednesday, we'll get that crucial U.S. CPI data. It's estimated to be near 9% consumer price growth. And Wall Street banks will be kicking off earnings on Thursday, including JP Morgan, Morgan Stanley, and Goldman Sachs. And finally, on Friday, China GDP data is released, Matt.
All right, now let's turn to really the juiciest story of the weekend, the Twitter takeover or not saga, which looks set to play out in the Delaware courts now. The social media giant preparing to sue Elon Musk to force him to follow through with his commitment to buy the company for $44 billion, or I guess, pay the billion-dollar breakup fee. Sonali Basak, our global finance correspondent, joins us for more. She's fresh out of Sun Valley, Idaho, where Elon Musk dodged questions on Twitter in his closed-door session on Saturday. What do we know?
Yeah, we know a few things here. We know that this could take months to play out. We know that Twitter is going to hold him to account. They have said so multiple times, and we know from Bloomberg's reporting that they've hired Wachtell to do so. Musk is also very heavily lawyered up. Skadden Arps had sent the letter, but we also know that he's working with Quinn Emanuel, who he has worked with before when it came to shareholder lawsuits, when it took Tesla, or said he would take Tesla private. So, of course, we know that this fight is going to play out in Delaware by hiring Wachtell. Remember, Twitter gets access to Leo Strine, who is something of a grandfather here in terms of Delaware law, given he was a chancellor of the Delaware court himself, and has really overseen issues like this, which come down to material adverse effect. Remember, it's not just about bots here. You have Elon Musk saying, yes, it's about bots, but he's also saying that the business has materially changed and adversely affected by the firing of employees, the hiring freeze, and other business matters that have seriously declined since he first made this offer.
Well, speaking of business matters, let's talk about the banks here, because if this deal doesn't go through, they stand to lose millions of dollars worth of fees.
And remember, what was remarkable is that Friday you had not only the Twitter executives, but also Elon Musk in the same place with one of their bankers, Allen and Company. The other bankers were not there, and some of them didn't even know that this filing was coming to scrap the deal, including some of the equity partners. So we were with some of those equity partners. They were surprised, yes, but also Elon Musk has been known to do this kind of thing before. So a lot of drama certainly about this.
And the spread was huge. I mean, if the market really believed this was going to happen, the stock would have traded above 40, closer to 54.20.
I have to tell you, me and Bloomberg Said Ludlow both spoke to investors who were thinking about getting into the stock, but were worried about the risk here into Friday night, which you saw before he scrapped the deal. But listen, guys, the thing here is, what will the next couple of months look like, and what kind of position is Twitter also put into? Their stock has significantly declined since then, and now they're also going to be tied up in a big, messy legal battle. And can they maintain business operations as normal until then?
Yeah, difficult to do business as usual when you're facing this kind of legal distraction. Sonali, thank you very much. Bloomberg's Sonali Basak with the latest on Twitter. Now, for the latest on the COVID outbreak in Shanghai. Well, it's getting larger. Cases have increased abruptly, despite officials declaring victory over COVID after 2 months of lockdowns. Enda Curran, our chief Asia economics correspondent, has the details. Enda, here we are again. Take us through the latest.
Yep, here we go again. Two new things. Cases are at around 70 now over the weekend. That's the highest. That's obviously a very low number, but the highest since May. And at the same time, the authorities have detected a case of the subvariant BA.5. So there are new rounds of mass testing underway in Shanghai. At the same time, China is seeing flare-ups around the country in other key cities, Shandong and down in the south in Guangdong. There's no hit to production or supply chains or anything yet. But the ongoing restrictions and the new mass testing that's being rolled out is again raising questions about what kind of a hit will there be to consumer confidence and, of course, the economy. We will get data on China later this week. We get both GDP and we get retail sales numbers for June. So all of that should give us a bit of a taste of how COVID-0 actually is impacting the economy.
Yeah, we'll look forward to that data at the end of the week. Meanwhile, over the weekend, of course, elsewhere in Asia, we saw those upper house elections in Japan, the LDP expanding its majority. What are the policy implications of that?
Well, the reaction from economists has been that it kind of cements Prime Minister Kishida's economic policy at the very least. It means the government doesn't have to face a national election now for 3 or so years. Prime Minister Kishida himself came out and spoke about the need to push through with policies that tackle inflation. He also said, though, they're going to push through with policies that make sure wages go up as well. So that's going to be a key trade-off to watch how that plays off. But as you mentioned, the overall takeaway was the LDP cementing its majority in the upper house after, of course, the assassination of former Prime Minister Abe. And most people responding to that today said it's just means stability, and it means Kishida can now go ahead and lock in his economic priorities for the years ahead.
All right, Enda, thanks very much for joining us. Enda Curran there, our chief Asia economics correspondent. Now, President Biden says his administration is still discussing possible action regarding U.S. tariffs on Chinese imports. Emily Wilkins, Bloomberg government reporter, has the latest out of D.C. So Biden expected to meet Xi in coming weeks. Emily.
Yes, a lot happening right now with the Washington-Beijing relationship. I mean, first and foremost, Commerce Secretary Gina Raimondo says that she does expect Biden to announce shortly whether he will be reducing some of those U.S. tariffs with China that we saw implemented during the Trump administration. We know that Biden had a meeting on this for the White House on Friday, but he told reporters on Sunday that he still has yet to make a decision. And there's division in the White House over exactly what should be done. You see Secretary Raimondo, Treasury Secretary Janet Yellen saying that it would be a good thing to lift some of these tariffs off consumer goods, get those prices down for Americans at a time of high inflation. At the same time, U.S. Trade Representative Katherine Tai says that those tariffs are important for ongoing U.S. negotiations with China. And of course, this comes as Secretary of State Anthony Blinken met with his Chinese counterpart at the sidelines of a G20 event. The two spoke for 5 hours on a number of topics, including Ukraine. Both sides said the conversations were incredibly candid. Secretary Blinken said that he told his counterpart that China could not be neutral in matters of Ukraine because there was a clear aggressor. And Blinken also said this sort of lays the groundwork for a potential upcoming call between President Biden and Chinese President Xi Jinping in the coming weeks, but no further details yet on exactly when that call will be.
Emily, thanks very much. Emily Wilkins of Bloomberg Government reporting there from Washington. Now, the main pipeline, thinking about what's going on with Russia there, as Emily was, the main pipeline bringing Russian gas to Europe goes down for 10 days of maintenance from today. The French Finance Minister, Bruno Le Maire, says the continent must prepare for Moscow to shut off supplies for good. Le Maire spoke at an economic conference in Aix-en-Provence.
We have to be prepared to all options. You know, that's the responsibility of all politicians to take into account the geopolitical situation. We have to take into account that cutting gas from Russia is one of the key options.
Joining us now for more is Birgit Jenen, our Berlin bureau chief. Birgit, is Germany concerned about Nord Stream 1 and the potential that it could be shut down? Of course, it's been shut down for maintenance, but on the other side of the maintenance, could it be shut down more permanently?
Clearly, the government is concerned. The economy minister, Robert Habeck, has said that it's totally unclear what is going to happen after the maintenance. And they do get mixed signals. On the one hand, they hear sometimes it's going to be cut off 100%, sometimes it's reduced to 50, 20%, or it can go back in full speed after the maintenance. But really, the government, given this uncertainty, is looking at all options, but also preparing for the worst case scenario, which is then that the companies have to ration their energy supply, and therefore they're looking at what companies can actually afford doing with less energy and what really need the full energy in order to keep up the production. This is one thing. The other thing the government is looking at, how can actually the rising costs be kind of compensated? And they are looking at subsidies as well as passing part of the rising cost to the consumers.
All right, Birgit, thanks so much. Birgit Jenen there, our Berlin bureau chief, talking to us about the possibility of Russia cutting off gas. Now, over in Britain, Foreign Secretary Liz Truss has launched her bid to replace Boris Johnson as party leader and prime minister. At the heart of her campaign are tax cuts, including a pledge to make corporate tax more competitive. Let's get more with Bloomberg's Lizzie Burden, who is at Westminster. Lizzie, talk to us about Liz Truss and the other candidates leading the race at this early stage.
Yeah, Matt, 11 candidates have thrown their hats officially into the ring so far, including Truss, and more are expected to do so in the coming hours and days. At this stage, the fault line is tax. So on the one hand, most candidates are trying to distance themselves from former Chancellor Rishi Sunak's position, which is to end the fairy tales and introduce some fiscal discipline in the post-pandemic recovery. The rest of the candidates are in an arms race for who can cut the taxes the most. But really, it begs the question, how inflationary will that be? But also, where will the money come from? Of course, it depends which taxes you cut. Aside from the tax debate, though, the mudslinging has already begun. A video of Sunak being dismissive about the working class has surfaced over the weekend. And the more the mudslinging continues, the harder it's going to be for whoever is the victor to unite the party ultimately.
All right, looking forward to seeing how this one plays out over the next couple of months. Bloomberg's Lizzie Burden reporting from Westminster. Thank you so much. Now let's get back to the U.S. markets and take a look at some stocks moving in pre-market trading. I mentioned the fact that Macau was shutting down pretty much all its businesses for a week, including casinos. That is weighing on U.S. casino operators that have big operations in Macau. With Las Vegas Sands down 4.6%, as is Wynn Resorts. Another stock moving lower is Alibaba. It was hit with those fines from Chinese regulators over past transactions, so that is weighing on the ADRs this morning, down about 3.6% before the bell. And finally, just coming back to that Twitter story after Elon Musk said he wants to scrap that $44 billion deal, you are seeing the shares down hard in early hours, down more than 6% at $34.50 a share. So, Anna, almost 20 full dollars below that $54.20 offer price.
Yeah, and we'll certainly get further analysis of that Twitter story and the falling apart of that bid later in the programme. Coming up next, though, Freya Beamish joins us, head of macro research at TS Lombard. We'll ask about the rise in yields that we saw on the back of that strong labour market data on Friday. Some of that being unwound this morning, but what did that mean in terms of market thinking? We'll talk about that and the earnings season still to come. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television, and focused firmly on inflation this week as we get a CPI read on Wednesday. I think we're expecting 8.8%. But as we saw last time, if it ticks just 0.1% higher than the estimate, we could see markets go absolutely haywire. Joining us now is Tatiana Dari of Bloomberg Markets Live. Tatiana, I guess inflation hasn't peaked.
Exactly. If you look at what economists are saying, and we could see, we are expected to go here to 8.8 from 8.6. And what is going to take us there is going to be surging gas prices. Yes, we have seen them roll off here in recent days, in recent weeks, but that didn't register that much for June. If you look at the average of the price throughout the month, so the BLS will just take the 4 weeks, average out the price, and we get to 4.9. That is about 11% higher than the 4.4 in May. So that really big difference, big gap there will take inflation higher. But it remains to be seen about the other components. What will shelter do? Economists have said that shelter is one of the areas that once it goes higher, it remains sticky. So really, how broad-based price growth will be, that could also impact markets even beyond the headline measure.
Well, speaking of the impact on markets, let's talk about the bond market, because on the one hand, if it comes in hot, it would solidify the expectation the Fed's going to be aggressive. You would think that means yields higher. But if they move too quickly, the market is concerned about a recession, which has kept yields kind of capped for now. How do you kind of assess that reaction and that tension within the bond market?
So we have to put it in context of the other economic data, right? We got jobs data on Friday, which showed us that the labor market is rock solid. That means if there is any slowdown, we are not seeing it in the jobs market just yet. That means wage growth remains elevated, keeps the pressure on inflation, and also that the Fed is not really concerned about the jobs market just yet, and they will squarely focus on inflation. And a headline number, if it comes in and as expected, it is enough to keep the Fed going at 75 basis points as expected now. But even if you look to September, already futures are pointing to something bigger than 50 basis points. So I think it will depend on the magnitude of the surprise. For stocks, though, they have moved the opposite way as treasuries completed their round trip above 3%. So I think stocks could be more at risk here from a surprise number.
Okay, Wednesday, that's when we have to wait to get the details there then. Tatiana, thank you very much. Tatiana Dario of Bloomberg Markets Live. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you go for the Markets Live blog. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. Former Donald Trump advisor Steve Bannon has agreed to testify before the January 6 committee. The former president waived an assertion of executive privilege that sought to block Bannon's testimony. Bannon allegedly pressed Trump to try to stop the certification of Joe Biden's presidential victory. The president of Sri Lanka agreed to resign hours after demonstrators stormed his residence. Gotabaya Rajapaksa had stayed in office during months of protests over fuel shortages, surging prices, and financial mismanagement. Sri Lanka is in talks with the IMF on a loan program to help pay for imports of food and fuel. Coming up, we'll talk markets and macro policy with Freya Beamish, head of macro research at TS Lombard. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Elon Musk makes a U-turn on Twitter. He's going to take his fight to the Delaware courts as the social media platform hires an M&A heavyweight to file suit. That could happen as soon as today. Another challenge to China's COVID-0 policy, a growing outbreak in Shanghai. Meanwhile, Presidents Biden and Xi are set to talk in coming weeks to discuss the easing of tariffs between the two largest economies in the world. Plus, a warning for Europe. French Finance Minister Bruno Le Maire says the continent must be ready for Russia to cut off gas deliveries completely in retaliation for sanctions. Le Maire says France should build up gas stockpiles and accelerate its program to build nuclear reactors. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European stocks under pressure, perhaps off earlier lows, but still suffering a little bit of lack of confidence in risk assets as we get ready for that CPI print and really feeling the pressure, I suppose, from that tight labour market report on Friday.
Yes, and earnings season. Don't leave that out, right? Because we get to see what margin compression looks like in this reporting season. Take a look at what we're dealing with here in the current moment. S&P futures off just 0.5%. We were up, I should say the S&P was up 1.9%, I think almost 2% at the end of last week. So it was the 9th week this year of gains, and maybe investors are feeling like taking a little profit off the table today. The dollar has been strong, and this is a story that Kailey and you have both touched on. Of course, we see it against the yen and the euro today, and it really affects commodities. So that's why you'll see, for example, at least one of the contributing factors to NYMEX crude coming down almost $2 now to 102.90. And investors are buying 10-year yield. That pushes the yield, 10-year debt, I should say, that pushes the yield down to right now 2.5 basis points to 3.056. But what's incredibly important and could go either way depending on your view, as Kailey was just saying there with Tatiana, is how you feel inflation is going to print on Wednesday and what that's going to do to the Fed's decision to focus on inflation rather than worry about a recession. Kailey, what do you see in terms of pre-market movers?
Well, Matt, we know there's really one story that's capturing all of our attention this morning, and that would be Twitter, after Elon Musk submitted that filing on Friday saying he wants to back out of that $44 billion deal. There is a question as to whether or not he actually can do that. It's likely going to be for a Delaware court to decide, as Anna mentioned. Nonetheless, you are seeing Twitter shares down substantially in early hours, nearly 7%, trading almost $20 below that $54.20 offer price, right now at $34.30. You also have Tesla shares a little bit lower as well by about 0.2%. Another story worth keeping an eye on is Uber. There were multiple reports over the weekend that Uber was lobbying politicians and potentially broke some laws a few years ago when it was trying to expand globally. So that weighing on the stock to the tune of almost 3%. And finally, one other stock to mention, Las Vegas Sands. This is one of the casino operators that has a big business in Macau. And now that Macau is closing all businesses, including casinos, for a week due to a COVID outbreak, that is weighing on those shares this morning, down about 4.6% before the bell, Anna.
Okay, a lot to talk about then when it comes to pre-market over in the United States. Here on the European session, weighed down by fears about tighter central bank policy seems to be the theme. And most of those European sectors are in negative territory this morning. Only utilities and healthcare moving higher. Elsewhere, we see a lot of negativity, in particular for basic resources and anything that is impacted by the global growth story. So basic resources and autos and parts, the worst performing sectors in today's session. We have the euro also under pressure, and increasingly so. 101.11 is where we trade on euro dollar. How quickly will we get to parity seems to be the obvious question we ask when it comes to the euro right now, although a lot of this is to do with the haven that is the US dollar, and seeking that haven today has weighed down on other currencies and interest rate differentials between the United States after that tight jobs report on Friday. That's very much in the market's mind as well. So the euro is weaker, the pound also weaker, the pound down in this morning's trading session by 0.8% against that stronger dollar. We have European gas prices just a little bit weaker this morning. They were down much more substantially, which was interesting on the day that we've seen the start of that 10-day maintenance period for the Nord Stream pipeline. And the big question, of course, that we talked about in the last hour is whether the flow of gas between Russia and Europe, which is going to be stopped for maintenance then, whether it will be restarted at the other side of that maintenance period, Matt.
All right, we'll be watching that story, of course, very closely. Joining us now is Freya Beamish, TS Lombard, head of macro research. And I got to ask you first about inflation, Freya. We see some indicators that it's peaked here in the U.S. If you look at food prices, if you look at energy prices, if you look at metals, right, they're coming back down. But we're still looking for a higher print on Wednesday. What are you expecting?
Even the peaks are I'm still nervous about this because the relationships have all reset. So the relationship between energy and CPI energy, the relationship between food and food energy, the relationship between things that should be driven by wages and actual wage inflation. You're all getting more inflation than you would expect for each of these different segments of the basket. So yes, the peak in year over year, but what we're more interested in is what's happening in terms of the month on month. And in the next few months or so, the best that we can hope for is that the sort of the compositional effects start to even out a bit, and that demand starts to find its new normal, and that starts to relieve a bit of the kind of the old bottleneck inflation that has been such a major component of what's going on here, and that distracts from the ongoing underlying mismatch between labor demand and labor supply, and demand and supply more generally, which we think is probably going to start to come back into the headlines. Or if we get this lull, the hope, as I said, but is probably the problem that is going to continue to resurface as the extent of the mismatch between demand and supply in the U.S. economy starts to make itself more known.
Okay, Freya, as you put it, when we return to a new normal then on demand, as there's been so much volatility of late and so many different crosswinds to take into account, where will that leave yields? Because they seem to have swung between various narratives in recent weeks.
Yeah, it's this kind of tug of war between, are we more worried about low growth or are we more worried about high inflation? And obviously from the bond perspective, the low growth thing should feed into a kind of peak in inflation trends, and start to bring that down and bring you into the kind of the quadrant of the cycle that is more benign towards bends. But unfortunately, we continue to have these shocks coming through, either from the energy side or from the simple fact that composition of demand hasn't yet normalized. I said the hope is that it normalizes. And therefore, you get this continual unveiling of different parts of the economy where there has been supply side atrophy, and where we're finding that at the moment is in the services sector as the composition of demand shifts back towards services. So we continue to have these kind of upside surprises. But as I said, the hope is that in the next kind of 6 months or so, you at least get a little bit of a lull there as you get some of the disinflation coming through from the sectors that did well in terms of high demand in the pandemic. And you get some of the commodities deflation coming through in terms of the decline in the level of prices. And you get some of that coming through in goods as well, particularly if you look at what's happening in China.
So, Freya, if you talk about disinflationary forces coming in the next 6 months, where is that going to leave the Federal Reserve and their ability to maybe press pause on their aggressive hiking?
So we see a few different scenarios here, and I will tell you our base case is essentially that they have to remain very hawkish, and that the rhetoric suggests that they won't take anything for granted. Like the whole raison d'etre of these guys is to prevent a rerun of the 70s, and they're scared across major central banks at the moment that is exactly what's happening. So the base case for us at the moment is that they do just they continue to look at the core. They continue to realize there's still heat in the core. Maybe average hourly earnings growth is starting to soften a little bit, and that suggests in the next few months that the core should start to cool just a little bit as well. But if you look at aggregate pay increases, that's still very, very fast. And the labor market is still, there's such a mismatch between demand and supply. It's softening just a tiny little bit. But the peak in the jolts is where we are in the jolts right now is about 1.5 times where it was the previous peak before COVID. So even for softening, it takes a long time for the Fed to actually be able to turn around. So the base case is that there's this sort of triangle in the expectation for, or the actual Fed funds path compared with what the expectation is at the moment, and the Fed has to continue to be more hawkish than markets are expecting. If more of this, the bullwhip effects start to come through, and we start to see more of the disinflationary forces kind of creating this mirage in the near term, then maybe you get a kind of a more of a validation of market expectations in the near term, but they're unable to support the recovery.
Is it possible to see a bullwhip effect in the labor market? I mean, we're all waiting on cars to be produced and delivered now, but Danielle DiMartino Booth says next year we might see a glut of cars, and the same in housing. Is it possible that we can turn on a dime in the labor market, go from, refusing 5 job offers this week to not finding any jobs next week?
So the high frequency data that we follow from global data, and it's scraped from company websites directly, and it's a good match across the whole globe, and that has turned down and has led the JOLTS data down in the past couple of months. But as I said, the kind of the level of the JOLTS data at this stage is just so high compared with previous peaks. And the supply in the market as well has not quite normalized yet. So participation rate is still low, and there's a missing group of laborers, which is the older generations. And even the migrant labor has come back a bit, but it's not reached previous trends. Whereas the things which we need them to be, we need these workers to be the sectors which need these workers at this stage are now experiencing a resurgence of demand. So there's just this big mismatch in supply and demand that's going to take a long time to clear.
Yeah. So even that softening in the JOLTS data, still a tight labour market. Freya, thank you very much for joining us. Freya Beamish of TS Lombard with her thoughts ahead of that inflation print and what we're seeing on other US data. Coming up, Bitcoin could be facing another 50% drop. We will bring you the latest from our Markets Live survey next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, U.S. Commerce Secretary Gina Raimondo. That's at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg.
We are in a crypto winter. So again, that could be an area where you dabble. I wouldn't necessarily allocate large chunks of my portfolio to it, but I am comfortable taking, smaller positions.
The volatility is excessive. It's volatility like currencies, but nevertheless, it can find a place in that portfolio. Notwithstanding, what I've said, it's very difficult to predict.
We struggle to find a valuation model. How do you value Bitcoin or the other cryptocurrency? So we have always advised our clients or investors to tread carefully.
It is very much a risk asset rather than a store of value. And it is, in some sense, a bet on a business model that has very much yet to be proven.
My suspicion is that this is here to stay. And I think that, as I said, you write off the mass movement of these super talented, super ambitious people at our peril.
A few of our guests there discussing what's next for Bitcoin. And the latest MLive survey says the token is more likely to tumble to $10,000, cutting its value roughly in half, than it is to rally back to $30,000. Emily Nicole, Bloomberg crypto reporter, joins us now for more. So, Emily, some 60% of people said it's more likely that Bitcoin goes lower than higher in the near term. That's not great.
Yeah, it doesn't bode well, I guess, for Bitcoin's price performance in the near term if we take those investors at their word. But obviously, Bitcoin has been trading range-bound around the $20,000 mark for at least a few weeks now. That's a little bit unheard of in crypto terms, right? Normally, we expect it to be incredibly volatile, and it really has been stuck there. It does kind of signal that investors aren't sure which way it's going to go, and even the results of this survey were quite split. 60-40 isn't necessarily a clear win.
So what do we know about the big whales in Bitcoin? What are the trends right now? Are they having to liquidate to cover other losses?
So what we're seeing is that a lot of the loans that have been made in the crypto space do use Bitcoin as collateral among other cryptocurrencies. Specifically, we've learned that there was a loan extended to Celsius, a lender that is currently facing troubles by Tether not long ago, that was also collateralized in Bitcoin, and that was liquidated a while back. And so we're starting to see how this contagion effect ripples across the market. You don't just see one asset getting affected when one loan has to be liquidated. It's usually a mixture of a lot of different cryptocurrencies. And that's why this is happening across the entire market at once, not just in one asset in particular.
Are we drawing any line in the sand? Are we putting in any fire break, Emily, between what we've seen so far in the crypto winter and what's still to come? Are we still seeing coins collapsing? We haven't talked about one for a few days. Is that positive?
I think it is definitely a positive. You know, this time around, there is a lot more money in the system than there was in the last crypto winter. You know, billions of dollars of venture capital money has gone into this space now. That's propping up these businesses, the programs behind the cryptocurrencies or even the exchanges themselves from entirely collapsing, because they don't just have crypto in their treasuries now, they also have real fiat hard cash. And so that's what makes this crypto winter quite different. Whether or not we'll see another cryptocurrency totally collapse in the way that Terra did, that was quite unique as well. You know, it was reliant on algorithms to keep its price going. It was a very specific kind of experiment with the nature of crypto finance. And so, you know, whether or not we'd see another of those is unknown.
Emily, there were so many interesting tidbits in this survey, one being that retail investors actually were more cautious about crypto than institutional investors who were maybe a little bit more open-minded. Another was that very few people actually saw NFTs as an investment opportunity. Can you just give us those details around that?
Yeah, so picking up on the NFTs, only 8% of investors saw NFTs as anything close to like a real investment opportunity. Most people actually picked them as more akin to art projects or country club memberships, which kind of tells you a little bit about how they're seeing the NFT market right now. We know that sales volume in NFTs has really stalled over the last year, and so demand is really flailing there. And then when it comes to, you know, skepticism around cryptocurrencies, more retail investors were skeptical around crypto, labeling them garbage, than professional investors. And actually around half of professional investors that responded to the survey said that they were, you know, somewhere between open-minded to, you know, Bitcoin maximalists, meaning they're completely all in on Bitcoin and nothing else. So it really is quite a wide range of opinion there, and we've definitely got some interesting results.
Yeah, very interesting readout of this survey. Bloomberg's Emily Nicole, thank you so much for joining us. And of course, for more crypto conversation, tune into Bloomberg Crypto every Tuesday at 1 p.m. New York time, 6 p.m. in London. It's Matt and I's weekly show, covers the people, transactions, and technology shaping the world of decentralized finance. So make sure to tune in tomorrow. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York and Anna Edwards in London. Tom Keene joins us now, co-anchor of Bloomberg Surveillance, to talk about one of the issues we've been highlighting all morning, Tom. That is the U.S. dollar, real strength coming back into the BBDXY.
Matt, it's Calculus Monday. Let's go to it. This is U.S. trade-weighted broad. This sort of is like the BBDXY, brings in the EM stresses as well. Stronger dollar, but slope matters. This is a log chart. And the slope of the 80s up to the Plaza Accord is a lot steeper than the slope we've seen over the last number of years. What we do have is a stunning persistency of strong dollar going back a good number of years. And all in all, it's over 50 years of strong dollar.
Well, speaking of stunning, Tom, I'm sure you will have a stunning conversation later on this morning. Leon Cooperman will be joining you on Surveillance.
Yeah, well, Leon's great. I mean, he and I can go an hour. We've done it. We've actually done seminars where I've gone an hour with Mr. Cooperman. But I'm really, really interested to see what Leon Cooperman thinks away from the equity markets, what he thinks about the carnage in the bond market, price down, yield up.
Tom, thanks so much. Tom Keene with a preview of what's to come on the next hour of programming. Right here and now, though, we'll pick up on one of the big pre-market stories of the morning. To Elon Musk, Twitter, as the social media giant, prepares to go to court to force Elon Musk to follow through with his commitment to buy the company. Bloomberg's Alex Webb joins us now. This has to go down as one of the biggest surprise, not surprise stories, I suppose, Alex, because yes, there was an expectation he'd buy it, but there was a growing expectation that maybe he wouldn't.
And it's also then been a kind of gauging whether it was actually that he didn't want to buy it or if it was a negotiating ploy. Now, it certainly seems like he doesn't want to buy it at this stage. If you look at the reasons why, well, you can see the share price now, admittedly, with the awareness that maybe the deal looks highly likely to fall apart. The shares are at $34-ish, I think, pre-market. The deal was at $54. How much of this is to do with the bots, which is what he's saying it's about, and how much of it is really to do with the fact that tech stocks are down, social media stocks in particular are down, and it looks a lot like he was overpaying.
Yeah. I mean, I don't see any surprise in this. If you read Matt Levine or if you watch the stock price, you knew it wasn't going to happen. And the bots, let's face it, seems like pretty much a made-up excuse that he's been using from the beginning.
Yeah, and I mean, there seems to be some sort of discrepancy, even if there is some truth to Elon's perception. Namely, he sort of sees that a lot of the accounts that engage with his posts are bots. Well, that doesn't necessarily mean that Twitter is wrong. It's just that the 180 million or so daily active users that Twitter says it has, well, it may have perhaps considerably more than that if you were to include the bots. So maybe that's the kind of discrepancy or disparity that we're seeing here, namely that Elon is picking and choosing what he sees as active accounts. But it certainly seems to be a tool rather than an actual reason for ditching the deal.
Okay, well, if he succeeds in ultimately ditching the deal, where does that leave Twitter? How much has its business been damaged by this whole saga?
I think the biggest damage has been the stasis, the sort of inability or unwillingness to make major changes, given that there looked like there was going to be a new leadership team coming into place. That's really tied the hands of Parag Agrawal, the CEO. There have been some comments from the sell-side analysts this morning saying that the effect of this, from a management perspective, is going to play out in the second, third quarters and beyond. Having a bit of clarity about where the ownership is going would be the most useful thing for Twitter, I think, at this stage, whichever way that happens to be.
Yeah, a little bit of certainty. I mean, briefly then, Alex, I mean, this goes to court now then. This will be settled in a courtroom.
Yes, and in Delaware, obviously where it's likely to happen, there are interesting precedents to this. 20 years ago, there was a deal in the meat industry, which a lot of people point towards, and in the time between the deal being agreed and the deal being completed, the market collapsed, and so the buyer tried to back out of it, pointing towards actually sort of similar reasons, not sharing accurate data. They were forced to complete that deal. It's a far smaller deal, $3.2 billion back in the day. That seems to be the case law that people are pointing towards as evidence that it'll be really hard for Elon to pull out of this.
Okay, so the precedent from the days before social media bots, but interesting analysis. Alex, thank you so much for joining us. Alex Webb of Bloomberg Quick Take. That is it for Early Edition. More surveillance is ahead. Tom, John and Lisa will take you through the next few hours. This is Bloomberg.